Imagine having a playbook that could help you not only navigate the unpredictable world of the stock market, but also build a solid financial future. The Intelligent Investor is that playbook, and it's so powerful that even Warren Buffett, one of the most successful investors of our time, learned from it. But have you wondered, what was so important that Warren Buffett even recommended this book to read? What valuable lessons helped him become a market legend? Today, we'll explore these invaluable 7 lessons through real-life examples. By the end of these lessons, you will be surprised at how simple methods can change your approach to investing. So, why is the Intelligent Investor important in the world of finance? Picture this. You're on a turbulent flight, and your pilot calmly explains the safety measures in place. That's what this book does for your investments. It's your financial seatbelt in a volatile market. All right, let's uncover its important lessons. Lesson 1. Stocks versus bonds. Let's begin by understanding the concept of stocks. What exactly is a stock? Imagine a pizza. A whole pizza represents a company. This company has divided itself into smaller slices. Each slice is like a tiny piece of ownership in the company. These slices are what we call stocks. So, if you own a stock, you own a small slice of that pizza, company. Just like with pizza, the value of your slice, stock, can go up or down based on how well the company is doing. If the company is successful, your slice becomes more valuable. If the company isn't doing well, your slice might be worth less. And here's the exciting part. You can buy and sell these pizza slices, stocks, in the stock market. So, when you buy a stock, you're essentially buying a piece of the company's future earnings and success. Now that we've got a handle on what stocks are, let's turn our attention to bonds. Imagine you're helping a friend by lending them some money. When you do this, you give your friend a specific amount of money with a clear promise. Your friend agrees to pay you back the money you lent them, and they'll also give you an extra thank you gift as a token of appreciation. Bonds work in a somewhat similar way. When you buy a bond, you're essentially lending money to a company or the government. They promise to pay back the money you lent them, the principal, after a certain period, which is like when your friend returns your loan. Plus, just like your friend might give you a small gift, the company or government also pays you interest for using your money. This interest is like your thank you gift. So, now that we have pizza slices, stocks, and friendly loans, bonds, you might be wondering when to invest in stocks and when to consider bonds. Let's break it down into a simple rule of thumb. Think of stocks as the engine for long-term growth. If your financial goals are far in the future, like retirement that's decades away, stocks are like the turbo boosters. They have the potential for higher returns, but they come with more ups and downs. So, when you have time on your side, consider investing in stocks for the long run. On another side, bonds as the safety net. They offer stability and regular income. If you're closer to your financial goal, like buying a house in a few years or funding your child's education, bonds act like the reliable brakes in your financial vehicle. They help you slow down and reduce the risk of losing money when you can't afford market turbulence. A practical approach is to use a mix of both stocks and bonds in your investment portfolio. The closer you are to your financial goals, the more you might want to shift toward bonds to protect your money. As you have more time on your side, consider adding more stocks for the potential of higher long-term growth. Remember, it's not about choosing one or the other. It's about finding the right balance that aligns with your financial goals and risk tolerance. By following this simple guideline, you'll have a clearer path to make informed investment decisions. In addition, I also suggest exploring other investment options like mutual funds, real estate, crypto, forex, commodity. It's important to understand and calculate the potential profit percentage for each option. So, keep learning. Now that you have a basic understanding, let me introduce you to a fascinating concept from Graham's book called Mr.Market and how you can take advantage of this concept in real life. Lesson 2. Mr.Market. Benjamin Graham presents an interesting concept in his book called Mr.Market. You might be wondering, who exactly is Mr. Market? Is he a real person? Mr. Market is a metaphorical character used by the author Benjamin Graham to represent the stock market. Mr. Market is described as a moody and emotional individual who offers to buy or sell stocks at different prices every day. Picture Mr. Market as your eccentric neighbor. One day, he offers you $1.10 for your $1.20 bill, and the next, he'll give you $50 for the same bill. The point is, he's irrational, and Graham's lesson here is to not let Mr. Market's mood swings dictate your investment decisions. This means that the stock market can be unpredictable and volatile, with prices changing rapidly based on various factors such as news, events, and investor sentiment. Now, you might be wondering, how can we take advantage of Mr. Market's irrationality? Let's say you've done your research and determined that the fair value of a company's stock is $50 per share. However, Mr. Market is feeling pessimistic and offers to sell the stock for $1.30 per share. This is a great opportunity to buy the stock at a discount and hold on to it. Now, let's say Mr. Market's mood swings in the opposite direction and he becomes optimistic, driving up the stock price to $1.70 per share. This is your cue to sell the stock for a profit of $1.20 per share. By buying low and selling high, you've taken advantage of Mr. Market's emotional behavior and made a profit. However, it's important to note that this approach requires discipline and patience, as it may take time for Mr. Market's mood swings to work in your favor. You may be wondering how to choose a best stock from the vast number of options available in the stock market. What is the secret to selecting the best stock? Fortunately, Graham also covers this important topic in the next lesson, which is called Fundamental Analysis. Lesson 3. Fundamental Analysis. As Benjamin Graham wisely puts it, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Graham introduces a crucial concept called fundamental analysis. But what is it? Why did Graham mention it? And how can you use this lesson in real life? Fundamental analysis is like peeling the layers of an onion to reveal its core. It's a method of evaluating a company's financial health by digging into its financial statements, earnings, assets, and liabilities. In essence, it helps you understand the true value of a company and its growth potential. Benjamin Graham emphasized fundamental analysis because it's the foundation of intelligent investing. By thoroughly assessing a company's fundamentals, you can make informed decisions rather than relying on market sentiment or short-term trends. Graham's approach seeks to buy stocks when their prices are below their intrinsic value. Now, how can you use this lesson in real life? Here's how, with a simple example. Imagine you're considering investing in two lemonade stands, Stand A and Stand B. Both seem promising, but their financials are different. Stand A has a consistent history of making $1,000 in profit each year, while Stand B's profits have been all over the place, ranging from $500 to $1,500 annually. Fundamental analysis encourages you to assess which stand is a more reliable investment. By looking at Stand A's consistent profits, you can estimate its intrinsic value and decide that it's a stable, long-term investment. Stand B, on the other hand, is riskier due to its inconsistent earnings. Fundamental analysis suggests it may not be the best choice for a long-term investment. Benjamin Graham emphasized fundamental analysis because it's the foundation of intelligent investing. By incorporating fundamental analysis into your investment strategy, you can make more informed choices. Rather than following market fads, you'll be investing based on real data and long-term value. Remember, Benjamin Graham's emphasis on fundamental analysis isn't just a concept. It's a practical tool that can help you navigate the stock market with confidence. Now, imagine you've done your research and found the perfect stock to invest in. But what happens when the market experiences fluctuations? What if the price of your stock suddenly drops? How would you handle such situations? This is where Graham's lesson on market fluctuations comes in, providing valuable insights on how to navigate these challenges. Lesson 4. Market Fluctuations. Picture this. You have a favorite restaurant that serves great food, but it can be packed one day and almost empty the next. Do you change your opinion about the food's quality based on the daily crowd? No, right? Graham advises you to apply the same principle to the stock market. Benjamin Graham doesn't just teach us to invest, he shows us how to harness the power of market fluctuations. But how do you take advantage of these market ups and downs, and what should you do in the long run? Market fluctuations are like the changing seasons. They're a natural part of the investment landscape. Instead of fearing them, you can take advantage of these fluctuations in a few ways. First, buy low, sell high. When the market is down, stocks often become more affordable. It's like a sale at your favorite store. Consider buying quality stocks at discounted prices during these times. Second, stay rational. Don't let emotions drive your decisions. Fear or excitement can lead to hasty choices. Staying calm and rational can help you make sound investment decisions. And last, value investing. Follow Benjamin Graham's value investing principles. Look for stocks trading below their intrinsic or fair value. These are often hidden gems waiting to be discovered. And remember, if you've already done your fundamental analysis and the company is strong with all the data in line, then market fluctuations during the season can be your ally. Now, assuming you have picked the best stock and have also handled market fluctuations using Graham's strategy, but you still want to be on the safer side and reduce the risk of losing money. What can you do? Here comes the lesson on margin of safety, which is really interesting and can help you have an extra cushion. Lesson 5. The margin of safety. Benjamin Graham introduces a vital concept in The Intelligent Investor known as the margin of safety. But what is it, and how can you benefit from it? The margin of safety is like an extra cushion of protection when you invest. Imagine you're building a bridge to cross a river. You want to ensure it can support not just your weight, but much more. The extra strength you build into the bridge is your margin of safety. In investing, it means buying a stock for less than it's truly worth. It's like purchasing a $100 item on sale for $70. If the item's actual value is $100, you've created a $30 margin of safety. Now, how can you benefit from the margin of safety? Let me also explain you by simple example. Imagine you're interested in buying a classic car and the market value for this car is $10,000. However, you find a seller willing to part with it for $7,000. By buying the car with a $3,000 discount, you've created a margin of safety. You can apply this same principle to stocks. If a stock is worth $100, but you buy it for $70, you've created a $30 margin of safety. This protects your investment and gives you peace of mind in uncertain market conditions. The margin of safety is your safety net in investing, ensuring that even if the market takes a temporary dip, you're protected. By understanding and applying this concept, you can make more confident and rational investment decisions. Now that you have a basic understanding of the fundamentals of stocks, let's explore the various investment styles and determine which style suits you best. We will also discuss how you can benefit from adopting this particular investing style. Lesson 6. Defensive versus enterprising investors. In The Intelligent Investor, Benjamin Graham categorizes investors into two groups: defensive and enterprising. But what do these terms mean, and how can you take advantage of these strategies? Defensive and enterprising investors are like two different approaches to the same puzzle. Investing? Defensive investors are cautious and prefer a conservative approach. They look for established companies with a strong track record. Imagine you're like someone who prefers reliable, dividend-paying stocks that may not soar in value but provide steady income. Enterprising investors, on the other hand, are more active and willing to take risks. You're like a treasure hunter searching for hidden gems. You're interested in undervalued or under-the-radar stocks that have the potential for significant growth but come with more risk. Let's consider a simple example to illustrate the difference between these two. Imagine you're investing in cars. A defensive investor might buy a reliable, well-known brand with a history of good performance. You're like someone choosing a well-established car company with a reliable track record. An enterprising investor, on the other hand, might look for a lesser-known startup car manufacturer. You see the potential for this new company to grow rapidly and produce innovative vehicles, but you're also aware of the higher risk. You got it, right? So, how can you take advantage of these approaches? As a defensive investor, if you prefer stability and don't want to constantly monitor your investments, focus on established dividend-paying stocks. These may not offer explosive growth, but they provide steady income and are less risky. And as enterprising investors, if you're willing to put in more effort and research, look for opportunities in lesser-known stocks with growth potential. However, be prepared for more market fluctuations and volatility. You can benefit by understanding your own risk tolerance and investment goals. Defensive investors can use a buy-and-hold strategy with well-established companies. Enterprising investors should perform in-depth research and be prepared to actively manage their investments. The choice between a defensive or enterprising strategy depends on your comfort level with risk and the time and effort you're willing to dedicate to investing. Whichever approach you choose, the intelligent investor offers timeless principles to help you succeed in the world of finance. Graham also introduced us to a valuable lesson known as value investing, which I find to be truly logical and practical. Let's get it. Lesson 7. Value investing. One of the cornerstone principles in The Intelligent Investor is value investing. But what is value investing? Why is it important? And how can you use it to your advantage? Value investing is like bargain shopping for stocks. It involves looking for stocks that are trading below their intrinsic or true value. Imagine you're at a flea market and you spot a vintage watch priced at $20. If you know it's worth $100, that's value investing. Let's illustrate this with a simple example. Think of buying a car. You find two identical cars, but one is listed for $10,000 and the other is on sale for $7,000. Value investing is like picking the $7,000 car because it's a great deal and you're getting more for your money. Here's how you can use value investing. 1. Research. Start by researching and analyzing stocks to determine their intrinsic value. Look at financial reports, earnings, and other data to identify undervalued stocks. 2. Margin of safety. Apply the margin of safety concept. Buy stocks at a price significantly below their intrinsic value to create a cushion for unexpected market fluctuations. 3. Long-term perspective. Value investing is for the long haul. Focus on the fundamentals of a company and its potential for growth over time. Value investing is important because it's a proven strategy to build wealth over the long term. It reduces the risk of overpaying for stocks and helps you make informed, rational investment decisions. Benjamin Graham believed in the power of value investing because it aligns with the principles of intelligent investing. By understanding and applying value investing, you can identify great investment opportunities, make well-informed decisions, and grow your wealth steadily over time. Now that we've covered all the lessons, it's time to put them into practice in the real world. To conclude, let me provide you with a simple example. Imagine you're considering investing in the stock market. You decide to apply the lessons learned from The Intelligent Investor to make informed decisions and increase your chances of success. First, you start by conducting fundamental analysis. You research different companies, looking for those with strong financials and promising growth potential. Let's say you come across company XYZ, a well-established tech company with consistent revenue growth, healthy profit margins, and a solid balance sheet. Taking a long-term perspective, you believe in the future prospects of the tech industry and the company's ability to adapt and innovate. You don't get swayed by short-term market fluctuations, but instead focus on the company's long-term growth potential. Considering the concept of a margin of safety, you analyze company XYZ's valuation and determine its fair value to be $100 per share. However, the stock is currently trading at $80 per share. Recognizing the opportunity, you purchase the stock at a discount to its intrinsic or fair value, providing a margin of safety against potential market downturns. To reduce risk, you diversify your portfolio. You invest not only in company XYZ, but also in other sectors like healthcare and energy. This way, if one sector faces challenges, your overall portfolio remains protected. Emotional discipline plays a crucial role throughout your investment journey. You stay rational and avoid making impulsive decisions based on fear or greed. Instead, you stick to your investment plan and remain focused on your long-term goals. As you monitor the market, you notice that company XYZ's stock price experiences fluctuations due to external factors. Rather than panicking, you see this as an opportunity to take advantage of market volatility. When the stock price drops temporarily, you consider buying more shares at a discounted price. Conversely, when the stock price rises significantly, you evaluate whether it's time to sell some shares and take profits. By applying these lessons from the intelligent investor, you navigate the world of stock investing with knowledge, emotional resilience, and a steadfast focus on the long term. Your portfolio becomes a puzzle assembled with careful consideration, diversified holdings, and a disciplined approach. Remember, this example is for illustrative purposes only. It's essential to conduct thorough research, seek professional advice, and tailor your investment decisions to your own financial situation and risk tolerance. If you found this summary helpful, please hit that like button and subscribe for more book summaries and investment insights. And remember, Benjamin Graham's timeless wisdom is just a book away. Happy investing, and I'll see you in the next video.